Back, everyone. It's the Small Business Tax School. We're really excited because we have a second episode with Carlotta Thompson. She is a former IRS agent, and I'm really excited about this episode because she's going to give us an inside perspective of what it's like to be an IRS auditor and what are the red flags that you should be avoiding when it comes to what you're doing in your tax planning and your tax situation, so that you don't have to unnecessarily go through an audit. Now, you might have one anyway, but now you're prepared and not having it forced upon you because you set off a red flag. So we're going to lean on her expertise here, and I'm really excited. So take advantage of this, take notes, learn what are the ways. I think this is important too, because we always have this huge fear of the IRS, and I think this perspective we're about to hear is going to help comfort some of that and give us some perspective about what is the process like and how can we prevent it, but what if we're in it, what is it going to go, what is it going to look like, and what's actually happening versus the make-believe stuff we put in our head, like jail time and endless punishment from the U.S. government. So without further ado, welcome back, Carlotta, and thanks for being here again.
Thank you so much. I appreciate you letting me come back. And I love this topic because the reason why accountants always don't want to always say everything's a red flag is because of fear. And the fear is because they don't know what goes on internally either. And so I love talking about the IRS because I have been on the side of the audit. I actually taught auditors while I was at the IRS, and I was on the classification team as well. We would have assignments to the classification team. So I got to see all the way up to what makes things come out to an audit, all the way down to doing the actual audit. And so super excited to be here. Thank you so much.
Yeah, this is an extraordinary episode for us, I think, because everyone's greatest fear whenever they hear like tax strategy or tax planning is, oh my gosh, this is going to cause an audit, or this is going to make me have to go through the pains of it, or they're going to take everything back and everything's going to go downhill. They just start telling all these stories in their head, and then they never actually take action. And so I think if people can know the actual insides out of like, what are the red flags of an audit, what is actually happening, I feel like the stories can go away, and then you can actually learn to take action and start implementing things that aren't illegal. They're just things you haven't heard of before.
Yeah. So a lot of people think that the red flags have something to do with what you actually took on your return. The IRS doesn't even know what you took on your return. They only have specific numbers that were brought to them from the tax return, which are very minimal in nature. Actually, they don't even get the whole return when they get it from the program. And so when you file your taxes, there is a code that you put on the program that tells the IRS what you do. This code should be the code that gives you the highest gross receipts, because this is going to be used in so many ways, and so many people, so many accountants will just put 99999. That is not smart. That's actually the biggest red flag, because the code is what sets the entire return up for review. So this one code takes everybody else within your code and compares it to your return. So everything is based on percentages. All right. So as a hairstylist, if you have 150% of your expenses, of your gross receipts spent on legal fees, and somebody has 10% and the majority has 10%, that's a red flag. So the red flags have nothing to do with the actual things people think are red flags. Home office deduction is not a red flag. This is ludicrous, and I hear that so often. Mileage is not a red flag. As long as you're in that percentage of what is considered normal for your industry, then you're golden. So how do we make the fear go away? Because most people are scared of something that doesn't exist. They're like, well, if I write off this thing that's not, the IRS doesn't know that you wrote that off until you're in an audit. And so it has nothing to do with what you're actually writing off. It has everything to do with where those numbers are placed on the return. Another thing is it comes down to how that return is prepared. I always will go through my returns and move things around because things can go on multiple line items. They don't actually have to go in a specific location. There's not like this like toilet paper can only go to office expense. It can actually go to office supplies. It could actually go to toiletries. It could actually go to, there's 3 places on the return where it would make sense for it to go. But when those numbers get high, according to the gross receipts, because maybe maybe they only had 3 categories and they grouped everything in those 3 categories. And so you got really high numbers in those places. Sometimes just breaking those out into the actual categories that would make more sense will lower that percentage, and it will make you not look so blatant to the IRS's electronic system. Remember, these things are first reviewed by a computer, and you get a score, a diff score. And then those come out to an actual person for review. So I am looking at those as a reviewer, and I'm like, okay, what are they telling me on this return? So a lot of accountants will put things to other expense. They'll put miscellaneous. That's a red flag. The IRS will bring that out to a person, and now we can see more of those numbers, okay? And so on those numbers, if we've got 50,000 on miscellaneous, what do you think we're going to do? We're people. We're looking at this from a personal standpoint. It doesn't take a rocket scientist. And the thing I would tell you to do as a business owner is to look at your return. A lot of you think you'll never understand it. But listen, it's just income and expenses. If you look at those things and you're like, that looks like that might be weird, or I don't even know what that would mean, then you might want to have your accountant look at that and change it to what it actually is. Because the more detail that's on there, the less of a chance you have of being audited. Now, is an audit even bad? No. If you didn't do anything wrong, you have no reason to even be scared. The problem with audits are the main reason things come out for audit is income. Income is a red flag because the IRS gets these things called 1099s. So, in the media right now, how the media is having a field day with a $600 or more Venmo, PayPal, whatever. If you have more than that in an account, then the IRS is going to have to start getting all that in a report. Right. And that didn't pass, by the way, but it will pass at some point to be an amount. The reason why the government is trying to do that is because they don't have enough information. People are hiding money. We have a problem in this country with people hiding money. And so does it mean that $600 you got in Venmo is now going to be a taxable income? Absolutely not. It just means that the IRS is now going to have a record of that. So if you've got, $5,000 as income on your return, but you're showing to have 500,000 of transactions, that's going to be a red flag. And the IRS is going to ask about that. A lot of people think that if you don't get a 1099, you don't have to report it. And that is also not the case. If you make more than $400, you have to report it, period. The 1099s are only a way for the IRS to know what you're doing. So did you know in business that when you have someone working for you, this is a contractor, you have to give them a 1099. We hear that all the time, right? They make more than $600, you have to give them a 1099. But did you know if you pay them through PayPal or Stripe or a credit card processor, if you give them a 1099, then that payment processor is also going to give them a 1099? And now you've duplicated their income. So the IRS is going to say, we've got this 1099 over here from Carlotta Thompson for $20,000. We've got this 1099 over here from PayPal for $20,000, or just say $40,000, right? Because PayPal is going to have a lot more than just my paying them. If we both give them a 1099 on the same income, now that person looks like they really made 100 or 60. Sorry, I couldn't remember the numbers I used. 60,000 when really in reality they only made 40. And so that is a red flag. How do you prevent that from happening? If someone asks you to give them a W-9 or for your 1099 that is going through a payment processor, you better show them the rules that is not allowable, because you're getting 1099 K'd on that money coming through a payment processor, and accountants miss that every time. So that's the things that's a red flag.
Yeah, that's really good. Yeah, that's good to know, because I think I'm just thinking back, because I've done a lot of different things, but like, I don't even know if anyone, I don't even know if do contractors even know, like, because I'm thinking about contractors, because that's who I'm thinking in my mind, like usually is getting paid through like PayPal. Like, do they even know that the 1099 is going to come, like that the IRS is getting a 1099 from PayPal for them? Like, no, I don't even know if people know.
It's actually in this weird spot in PayPal. You have to go find it.
Yeah, that's interesting. I think that's an important thing to know. And I think what you've described is very helpful for people, is how you're classifying income matters. The fact that you're putting yourself in the same business category as your actual industry matters, because you're being compared to your other peers in your industry when it comes to expenses. That's important. And then making sure that you are, again, it goes back to our last episode, it's making sure that you're taking accountability for your return. So you're reviewing it, you're making, okay, what is this? This looks a little funky. Can you just explain this to me? It doesn't take them a ton of time to explain it to them, but now you can point out and see, like, okay, everything looks fine here. Like, we've identified that I'm a contractor. All the expenses look like they're in a good spot. Doesn't look like anything's out of the ordinary. I don't have 50,000 in miscellaneous. Everything's got a category. And then now you can feel comfortable. I can put this in and it's not going to trigger anything, because I think what you described is very powerful for people, at least in my opinion, because I think people think there's some sort of like, they're like looking to just look at my tax return and find this. They're going to know that I purchased a boat I realize they're going to find it. They're going to know it. They're going to know that I did this thing, but they don't know it. It's just numbers they're looking at. There's no big obvious, look at this. But if you categorize things incorrectly, that's the big halo dot pointing, there's something wrong here. And that's what they're looking for. And that's probably the biggest thing that you've seen. Is that correct? Did I understand that correctly? Is the miscategorization of stuff? It's
not even that it's the wrong category. It's that the category got too high.
Got it.
So
okay.
They'll put so much in one category, because like software, office, toilet paper, computers could all go under office supplies, but that makes that now so big in relation to your income that if you just split that stuff out a little bit and maybe put it on other expense software, then the IRS can now see that, okay, it's really not just office supplies. It's not pens and paper. It's actually monitors. It's like, what is it here we're doing? And that way they can see more of it. Another thing is, like, if you're paying coaches, coaching is a big thing right now, like masterminds, online masterminds. I always put that to contractors, because of any other place, it looks odd and it's crazy. But remember, us online entrepreneurs are very rare. Though you feel it because we're all on here and we're in this bubble, it's actually very rare. And so if you put that where it's in a place, now you don't have to do a 1099 on them, because you're usually paying them through a Stripe or something like that, but you're paying them for a service. If you'll move it over there, it looks more correct to the IRS. Now, could it go on other mastermind or other coaching or other education? Absolutely. But whenever you've got to look at everything from like a normal business perspective, what would normally go in those places. And so that's what my focus is getting those things in the right place. But again, who cares if we are audited if we have the proper documentation? So I always say report all of your income, because that is the most important. Secondly, make sure that you have representation if you ever get an audit, because you should not be representing yourself. Because usually you'll say something that can be construed incorrectly.
Got it.
There was something else I was going to say that had to do with miscellaneous, but I'll come back to that in a second.
Okay.
Go ahead.
So my next question is, okay, let's say someone, they they've been honest, they didn't do anything wrong, but they're in an audit. Can you just briefly describe to them, like, what is going to happen? What are the steps so that they know what's happening? And then how do they best, you mentioned get representation, but what are the best things they can do to handle the audit in the most efficient and unstressful environment for both parties, the auditor and then themselves, so they feel like, okay, if this does happen, I'm at least prepared and have a vision of what's going to happen, and I'm not too scared. I'm not freaking myself out, not sleeping. Because if you do that, now you're losing productivity as a business owner. You're not being as good with your family. Like, that has negative effects all over the place. So if they have that clarity, I think that would really help people. So if you could provide insight into that process and then help them understand how to best handle it, I think that's be beneficial.
And just so you'll know, it's very rare to get an audit. So you probably will be in business for 30 years and maybe get one audit. And it may not even be from the IRS, it may be from the state. So it's very rare. So first of all, don't freak yourself out about an audit until it happens, because it's very rare anyway. People ask me, like, how do I keep up with things for my books? I throw it in a box or I take pictures. Like, it's not organized, because I know the chances of getting an audit are very rare. And at least I have it all if I ever did. Next, the way this works is you're going to get a letter or a call, and they do call. Maybe they don't call anymore, but they used to call, even whenever it was like, they don't call you. But they'll call you. They'll give you their ID, and they'll send you a letter as well. Don't give them any information. If they do call you, just be like, please send me a letter. Because that's really ridiculous that the IRS would ever call. But when we had to cold call people, and it was horrible. So they'll send you a letter, and they'll say you're under audit, and they'll be looking at usually 3 things. Okay. So from those 3 things, they'll pick 3 classified issues. And as long as those 3 classified issues are good, they don't see anything LUQ in the audit, then you'll just have to substantiate those 3 issues. The best thing you can do in your audit is to go through your tax return and see where everything was, and have you or your accountant match up to every line. So you know where everything was put on that return before you start. And if there's an accountant listening to this, that's the best thing you can do too. And that way, nothing goes outside of those 3 classified issues unless they see something in the general ledger. Okay. So the 3 classified issues, and there's sometimes more, but usually they usually pick 3, and you give them what's in there, and you tell them what each thing, if they ask you what this was for, you give it to them. The less talking, the better. You jabbering to this agent is going to hurt you, not help you. We as an agent is really good at being friendly, because that's how we learn everything, right? Like, our job is to go in there and make sure that the return is right. I'm friendly because I'm friendly. Like, I'm helping you do tax. If I'm your auditor, I'm helping you do tax strategy as well while I'm in there, because I don't want to give you a big tax bill, and I want to make sure that it was beautiful when you leave. But that's not the most part. That's not who auditors are. They have a job to do. And so the less talking, the better. Having a barrier, even if it's not the person that prepared the return, just having that barrier so you can think. Because if you can't think on the fly of how this stuff should look, you may mistakenly say something that was for sure an expense, but you mistakenly said something else, and now they will instantly think that you are not telling the truth. Because remember, most of the people that get audited by the IRS are hiding something. It's very rare to audit someone that wasn't hiding income. I love it when I find people who aren't hiding income, because I can trust them on the other things.
Right.
So if you're honest and you're not hiding income, I would say you're up. You're a step up, because they're already going to trust you, because that's the first thing they look at is income. But the expenses, just matching those and knowing what they are for, and knowing the co-enroll. If you don't have the receipt, you mention co-enroll, and the IRS will say, okay, what oral testimony, recreation of records. If you don't have mileage log, you can recreate those. If those things, just knowing those things. But it's literally, sometimes they're in the office, sometimes they're by mail, sometimes they come to your house. There's 3 different ways they can come. They last for months. It ain't happening fast. Most audits that are in the field, which are at your house or business location, usually last for over a year. Don't rush it, because the more you rush them, the more they have time to find things. They only have a certain amount of time to finish that until their manager gets on them. Well, if you're their perfect client and you're giving them everything they need up front, who do you think's getting the more attention? It's you, because they have to keep that stuff moving. And the more you give them, now meet the deadlines. But I have a case right now, which is not my own. I didn't do the return. I'm just representing. And I don't do this often, so please don't come to me for a bunch of tax representation, but I'm just giving you my secrets. The auditor literally has had this audit 6 months, has never opened it. We've sent her information. We've called 3 times because the client has made us. And I told the client, I said, you're making a mistake. Do not keep calling this lady. The best thing that could happen for you is they survey this out. The last call we heard, she's retiring. Do not contact this lady again. She is retiring. The best thing that can happen for us is for her not to do this audit. Like, leave them alone. It makes you feel scared, but why are you scared if you weren't hiding anything? Don't hide anything. You have nothing to fear. Let it take its time. Don't be overly giving of information. You give them exactly what they've asked for. And if they don't ask for samples of stuff, if they don't ask for like a sample of the expenses, you go back to them and you say, I need you to sample this. Because auditors will ask for everything, but you don't have to give them everything. They actually have a handbook that if you have someone representing you that's really good, they can say, we need you to sample this. We need you to do this. This is a national research project that I'm working on, which means they audit every single line. The auditor asked for every single receipt. I said, no, ma'am. You aren't allowed to ask for every single receipt. You can pull me a sample and I will give you those receipts. Then we have the Cohen rule. Like, it's all about having good representation. But if you're going to represent yourself, everything I'm doing here, replay this episode. I'm giving you all the insider secrets from the IRS.
That's fabulous. I think that because no one even has any idea how this goes. Like, if they haven't been through it, they have no idea. And so then when they get the IRS agents like, give me everything, everyone's like, oh my gosh, that's what stresses people out, I think, is because I don't know if I have everything. They know they didn't tell, they know they're not hiding anything, but they're like, I don't know if I can show everything, because it's like, that's a long time ago. I don't know if I kept everything. I could have missed something. So then they start panicking. I think what you just described is very valuable. Like, that's for the stress sake of things. I think that's one of the most valuable things someone could hear is just give me a sample of what you want and I'll give you the sample and nothing else. I think that's cool. And the Cohen rule is very powerful too. That's powerful.
It's the most powerful tool that you have. And the IRS would never tell you about it. Never.
Yeah.
But it's powerful.
Yeah, that's awesome.
I think I need to open a business just teaching people how to
you could sell it to accountants. Just give like an online course of like, how do you represent your client in case of an audit?
For sure. I should do that.
So is there anything else that you think would be valuable for people to know concerning audits and red flags and things like that we haven't talked about, that you think this is something I'd like to share so they can feel more comfort and know about the situation?
So the red flags, there are a few red flags that are definitely red flags. An S corporation with no reasonable compensation is a red flag. I always will, if there is actual owners on there, if the owners are LLCs, then that's not, but otherwise it is a red flag. So make sure that you are paying a wage out if you are an S corporation. I think that the red flags are more detail, right? Like anything that you're combining together, anything that gets over, several $1,000s, $100,000, you better be breaking that out, like, or being more specific. Accountants don't realize that, but you as a business owner can look through that and say, hey, what do we need to do here? But yeah, just knowing, a few years ago, during one of the takedowns of one of the largest corporations. I cannot remember the name of it, but it was all over the news. The person signing the return, which was the owner, said he signed it and he tried to blame everything on their accountant, Enron, right?
Yeah. Okay.
And so we came out with IRS came out with all these new rules that said, you are responsible for your return. Guys, I've had accountants deduct businesses that were not the person's business. I've had them deduct cars. Like, I literally had someone deduct a state trooper car on the employee business expenses. Okay.
Wow.
All the mileage, a state trooper car. You cannot deduct things you don't own. I mean, just literally things that you know better. It came back on the guy that signed the return. It is very, very, very hard to blame anything on an accountant. So take pride in what you're signing. It is not hard to review. You're just scared. I challenge everyone that listens to this is, first of all, go review your last return page by page. Guys, our ancestors did these things by hand. There weren't always accountants doing this stuff. I still know people that do it by hand. It's not that difficult to know the ins and outs. The credits are what's difficult. The income and expenses are not difficult. That's number one. Number two, I challenge you to go and see how much tax you're paying. There are different lines on that return that say, this is your total tax. These are your other taxes. Adding those two up will tell you how much in taxes you're actually paying. It's before all those credits, because you would get those credits back. Most people do not know how much in tax they pay.
Yeah.
And I challenge you to go and find what your actual income tax is. So whenever you think, oh, I only paid $2,000 in this year, I'm doing great. You forget the $20,000 that was withheld from the W-2. You forget the estimates. You forget all the other taxes that were paid and all of the other credits that you would have gotten had you not had to pay those. And so I just challenge you to actually go and figure out how much you're paying in taxes.
Cool. I really like that. And I'm really grateful that you were on the show today. I think there's a lot of value for people to hear what an IRS audit is like, and then what are the red flags that are out there for people. I think that's a big thing. One thing I want, because I think a lot of our listeners have heard of things like there's listed transactions like the conservation easement, which can have a big tax impact. Can you talk about that? Do you know much about those? Like, what is the implication on the tax audit side for people with those? Because I think a lot of high income earners specifically are aware of those, but I think there's mysterious about, like, is the IRS hates it, but like, what is the, just provide your insight on that from your perspective.
Yeah. So at the IRS, they come out with different audits for different things like that. So R&D credit was huge while I was there. Conservation easement is now huge. The IRS is wanting to make sure that you're within the guidelines, which most people are not, because they've been sold some conservation easement that was too good to be true. And so what's going to happen is the IRS is going to audit all those. They'll do projects. They'll pull every single person that has that conservation easement on their return, and they're going to audit it. It's normally to that one specific issue, unless your return looks crazy in other places. Conservation easement is one of those promoter strategies that I never got on board with. Remember, whenever I said, if it's too good to be true, be careful. Now, does that mean that they're all wrong? No. But just like an R&D credit, back whenever that was a new credit, people were sloppily doing R&D credit and not getting the facts and circumstances correct. And so when you do any kind of strategy like that, you have to make sure that you have all the correct documentation. So what you're going to be relying on for that conservation easement is the person that did it for you. And they will have all of their documentation, because normally they're getting all of their clients are coming back for this at the same time. So you want to go back. If you did it with someone else, you want to go back and just get all that documentation together. Also, if you did a conservation easement, just like R&D credit or any other credits, ERC credit may be one that they come back after because there's just a lot of fraud in them.
Yeah.
Right. I mean, you committed fraud. It just means, guys, I'm seeing people go to jail every day because they claimed ERC credit and they don't even have employees. Like, it's a very high.
Right.
Anytime the government gives millions of dollars away, it's going to be high fraud. And so just going back to that place that helped you, they usually provide an audit protection, and they will give you all the documentation you need for that. That's where you go. If you had a good, solid person, you're going to be fine. If you had someone that, I mean, I compare it to the people that used to sell the bootleg CDs on the side of the road. Like, you may not be in a good place, but if you had a solid company doing it, then go back to them and get all the documentation to represent you in that audit. It's not the conservation easement was bad. It's not the opportunity zones are bad. It's not, all those are legitimate black and white tax strategies. But when anything is high fraud, the IRS is going to do, and they're going to pull all of them. They do this with different industries too. When I was there, we did one on coin laundry and I think hair stylist or something. And they do projects and they do calculations and they can tell how much money you deposit in the bank and how much you should have had. And they'll back into that and you'll get audited. And so they do that industry specific stuff all the time. Again, it's not a bad place to be, but if you are doing one of those one-off strategies, make sure that you go back to the person that did it for you.
I like that. I think it's again, it takes accountability on themselves, but I think it's also important for people to realize that there could be negative things said about different strategies and things, but you just got to find the company that's going to do it the right way. And as long as you're being honest and they're being honest and everything's being documented and substantiated correctly, like, you're going to be okay. Maybe you'll get an audit from it, maybe potentially, like maybe it increases a little bit, but like, you're going to be okay. Honesty is the best policy in everything in life, but specifically with taxes.
And conservation credits were widely done. It wasn't, I call it a promoter. It really wasn't a promoter strategy because everyone was doing them. And they still are. R&D credits, same way. It's very black and white. It's actual thing because people need it. The strategies you need to be scared of are the ones that say you don't need to pay taxes because you can, in the Constitution, it says we don't have to pay taxes. The ones that say you can put everything into a ministry and you can pay for your house out of there. I mean, just things that are just like too good to be true. You can pay for all your personal expenses out of something and deduct it all. Guys, that's bogus. You can put everything in a trust and never have to pay taxes, and you can just live out of the trust and pay all your food. Like, that's bogus, guys. That's not real life. So what I always say is, if you're going to do a strategy that's like, you come up with some new strategy and you've heard of one time, go and look and see how many other companies are doing that strategy. If there's one company that does it or 10 companies that do it, run. There should be hundreds of Google it. There should be hundreds of documents on it if it's a wide known strategy that is. And when we say strategy like that, it's a tax law strategy. I think people who are trying to promote something that's not real will also say it's a tax strategy, but really it's just a con. So you have to be very diligent in that.
Yeah, I think I think if there's I like what you just said. Like, I think you do research, like, don't just take people's word for it. Do due diligence, ask for other people's opinion. I like the look at how many companies there are, because if there's one company, like you said, the chances are much smaller that it's legitimate. But I think
they put their name on it.
Right.
That's another thing I see with people that have promoter strategies. Well, they give you a document that says they'll pay if something happens. Yeah. Because like all of our stuff, I will protect you. Now I'm not going to pay if you screwed up and you didn't do it, but there's nothing like if you screwed up, like you told me something that was not true. But if you're honest and I'm honest, I'm going to take care of you. Most people, which I don't even have any promoter strategies, but if I did, that's the kind of confirmation I would want. I get asked every single day, is this legit, Carlotta? This person's peddling this strategy and they're the only ones that do it. And I'm like, ask them if they'll put their name on it. If they'll sign saying if you got audited, they'll take care of you. If they won't, absolutely not.
Yeah.
Because I'm not going to jail for you. They're not either.
Yeah. I really like that one probably best, is because if they do that, then they have to justify it. They have to back it up, and they're going to, if they're wrong, like then you could have, because of the situation, because it's such a specific strategy, they could get in trouble themselves. And so if they're trusting on someone else to do it, then that's a great point. I think that's a great indicator of truth versus not when it comes to that. Are they willing to back it up before the taxing authorities that are going to question them on it? Because if they're not, that's probably the biggest red flag we could say is, if they're not willing to do it, then what's going on here? Like, that's something pretty fishy. If you're not even going to back up what you're selling, that's bad.
Yeah. And most of those tax strategists will only have like one strategy too. They don't have they're just con artists, and they're trying to make like tax is easy to sell. So they'll sell them some con, but let's go back to the basics, guys. Look, don't try to find all those things. There's so many things that you can do that are within the limits that are black and white. There's nothing you need to do, like real estate, business acquisitions, the strategies I already gave you. Like, those are a dime a dozen. Everybody does them. Everybody knows about them. Every accountant knows about them. The only thing they don't know about is the documentation. And so they just won't do them because they don't want to do the documentation. So just keep it simple. Don't try to go extravagant. The people I see going extravagant usually know that what they're doing is probably not going to be allowed. Okay. So use common sense. Let's just go back to that. Use common sense. That's really all you have to do. If something smells fishy, don't do it.
Yeah. I like that. Well, I really appreciate your time. It's been a pleasure. Let's do one more time where you let people know where to find you and how to get in contact with you, how to do business with you, so that they can hear that again. I know we did on the last episode, but let's do it again so you can promote yourself and they can find you, because I think there's a ton of value you're providing to the world.
Yeah. So we have the Company Tax Strategist of America. You can find me at carlottathompson.com, and you can find Tax Strategist of America through there. On the show notes, you're going to see a link for this podcast where you guys can come and listen to our webinar on how to pay zero tax. It's the only way to actually purchase from us, because we want you to know what you're purchasing. We are very efficient at tax strategy. On the webinar, you will find out exactly how much money you can save just from using 3 strategies that we implement for you. And our services are way cheaper than what we save you. And that is very rare to find. A lot of tax strategists are going to give you a plan. They're going to give you that hit of dopamine, and you're not going to get anything after that. No implementation. We don't work like that. Everything we do is implementation. We give you a plan just so you know what's happening, but you don't pay for a plan. We are just really focused on helping you get the tax deductions that are already there, because, I mean, why is the IRS why are they not calling you, telling you this stuff? Like, you missed this, you should be deducting this. They're just not. And so they do that for individuals, but they're not doing that for business owners. So we have to take care of you, and that's what we're here for.
Awesome. Well, thank you very much. I appreciate it. I hope everyone has learned a lot in the last 2 episodes, but most importantly, I hope we take action. Take action, start implementing strategies, start saving taxes, start bringing more value to the world because you have more money, and let's go get it done. Thanks for listening, and we'll see you next time.